Good evening, everyone. My apologies about that. We have a new feature this week. We have live transcript is available. So if at any point you lose audio, you will still be able to read what we are all saying, or not we, Art and Don. Thanks for joining us for the new dentist presentation, part 1. My name is Amanda O'Brien. I will be your webinar specialist this evening. A few housekeeping notes before we begin. You are muted and your video is turned off. However, if you have questions for Art and Don during the presentation, please utilize the Q&A function. I'm also going to launch a quick poll just for fun to see whose background you like better. Art's professional Eide Bailey background or Don's dental appropriate.
Whimsical.
Whimsical.
That's a big word for you, whimsical. That's really big.
I don't go beyond 2 syllables normally. You know that. I learned that from you.
That's right.
We'll give everyone about, let's say, 15 more seconds to do that, and then I will.
Oh, I'm getting clobbered here, buddy. I'm getting clobbered here. Yeah, you had the right idea. All right, we'll have to get me something better next time.
It is 6 o'clock at night, you know.
Okay.
For most.
All right. There we go. Polling is closed.
Okay.
Nice.
Looks like you won.
All right. With that, I will turn our time over to.
Okay. Amanda, thank you so much, and welcome everyone to our first of 2 new dentist presentations, which are sponsored by 6 of our wonderful local dental societies. And tonight, we're going to do tonight, and then we're going to do one again February 23rd at the same time. So I'll go through the agenda that we're going to cover tonight, Don and I, in a second. But next month, February 23rd, from 6 to 8 p.m., we're going to have 2 very, very special guests. We're going to have Anita York, who is an attorney who specializes in labor law, is going to talk to new dentist owners and independent contractors about the legal aspects of independent contractor employee, hiring employees, and starting up a practice. And then we're going to have Jennifer Chevalier from Fortune Management, who's going to talk to you about the basics of setting up really good systems when you either start or buy a practice. So the purpose of this series is to help our doctors who are either in school or have just graduated, and maybe you're working as an associate dentist, or maybe you're either in the process of buying a practice or you've just bought a practice. And that's what we're going to cover tonight. So I want to welcome my good friend and colleague, Don Watson. How you doing, Don?
Doing great tonight. How are you, Art?
Well, I was doing fine until you got like 86% because they like your teeth background, but that's the way it goes.
You know.
Don is, I am a, and let's see, Amanda, do I have control of the screen? I don't. Oh, it says, yeah, I can't. Amanda, are you there? I can't control the screen.
I'm here. 1 second.
Okay, yeah.
Sorry about that.
Sorry about that. So, okay, so we're going to give me control of the screen. And tonight we're going to talk about a lot of different topics, which I think will be of great interest to you. And just let me know, Amanda, when I'm ready to go here. Okay, so.
It should be good.
All right, let's see here. No, not feeling the love, Amanda. Let's see. There's no. Yeah, it's not letting me
advance.
Yeah, it's not.
No worries, I've got you.
Okay, all right. So let's go to the next. I'm sorry. Let's go to the next one. All right. So the first thing I want to share with you guys is that I do a weekly podcast where we cover a lot of different topics on dental finance and management. It's called The Art of Dental Finance and Management. This coming week, actually tomorrow, will be published a podcast which is going to be on the new Paycheck Protection Program Round 2 applications. How do you know how much to apply for? And also the forgiveness forms. And we have a lot of great guests coming up, including in February, we're going to have actually the the current president of the American Dental Association, will be coming on to talk about what's going on in dentistry. So be sure to listen to that. We're keeping all of the dentists and the entire dental community updated on what's going on with the Paycheck Protection Program, the HHS Provider Relief Fund, and all that stuff. So keep that posted. Amanda, let's go ahead and advance again, please. So again, my name is Art Wiederman. I am the director of dental practice. I'm a dental director at the CPA firm of Eide Bailey. And Don Watson is a partner and is actually the director of our dental division in Tustin. Both of us, we work with about 250 to 300 dentists in our practice in Tustin, doing accounting, taxes, financial planning, pretty much anything you need on the financial realm. That's what we do. So we'll be here to present this seminar tonight. Before we get to the agenda, what I would like to do is I would like to thank the 6 executive directors of these wonderful dental societies that in tandem with Eide Bailey had put this together. That would be Kristen Avina from the Harbor Dental Society, Megan Francis from the Orange County Dental Society, Lee Adishian from the San Gabriel Valley Dental Society, Michelle Schneider from the West Los Angeles Dental Society, Kurt Thornton from the San Fernando Valley Dental Society, and Greg Orloff, who I spoke with this morning, from the Los Angeles Dental Society. Thank you, executive directors, for everything that you've done to help put these programs together. All right, with no further ado, Amanda, let's get started. Let's go to the next slide. We can try this again a little later to give me control of the screen, but let's go ahead. So here's what we're going to cover tonight, folks. We're going to start out with basic financial planning for all of you. You're all getting started in your careers. We want you to be wildly successful. I will tell you that 3 to 4% of all dentists in America, unfortunately, have the financial ability to retire at the age of 65. That is a statistic that's come out from many different places, including the ADA. And we would like to get you on the road started so that you are one of those 3 or 4%, or that we can actually get that percentage up. So we're going to talk about what I call Art's golden rules, basic financial planning. Then Don's going to jump in and talk to you about associateships, independent contractor versus employee. We're not going to go into the legal aspects because that's an hour conversation, but we're going to talk to you about the financial and tax ramifications of being classified as someone working as an independent contractor or an employee. And Don's going to also share with you some thoughts on how you plan your taxes as an associate dentist. Should you incorporate, and when do you do that? And most of you are going to end up as S corporations or are already S corporations. So how does that work? And then I'll jump back in and Don and I will talk about tax saving ideas for practice owners. Don will share with you some thoughts on using QuickBooks in your dental practice. And then I'm going to go through some key performance indicators in your dental practice. And then that's going to take up a good amount of time. If you have questions, send them to the Q&A and we'll get to them as we kind of go along here. So Amanda, let's move along here. I will read this disclaimer. These materials and the accompanying oral presentation are for educational purposes only and are not intended to be written advice concerning one or more federal tax matters subject to the requirements of Section 10.37A2 of Treasury Department Circular 230. This information is of a general nature and based on authorities that are subject to change, member FDIC, ESPN, and HBO. All right, let's move forward. So let's start off. And folks, there are 7 areas of financial planning that you can deal with. And they are as follows: budgeting and how you spend your money, taxes, retirement planning, college education planning, insurance, investments, and estate planning. We are going to have we're doing a year-long Business of Dentistry webinar the second Wednesday of every month. We've had one already, Kira Dent. Next February 10th, we're going to have Christy Boltz talking about marketing. And I think sometime in the fall, we're going to do one with our financial planning team at Eide, where we're actually going to bring up our retirement program and show you different ways to plan your retirement. So those are the areas, but I'm going to give you some golden rules for you starting out as young dentists. Some of you are single, some of you are married, some of you own practices, some of you own practices together. So let's start out with my 65, 25, 10 rule. So the 65, 25, 10 rule says, and we'll just make it an easy. Let's assume you earn $100,000 gross working as an associate dentist or in your dental practice. We recommend that you spend about 65% of your money on your personal living expenses. And that is your home and food and clothing and utilities and golf and all that kind of fun stuff. 25% of what you earn is going to go to taxes. Now, if some of you go, well, I pay a lot more. What you pay in taxes really depends on how much money you make and whether you own a home or you give money to charity. But for most of you living in the state of California, give or take 3 or 4 or 5%, you're probably paying about 25% in taxes. And the remaining 10% we want you to save. Unfortunately, many of our clients, and Don can attest to this, live by the 90, 25, minus 15 rule, which is they live on 90% of what they make. They struggle to pay their 25% in taxes, often go in the hole and use the IRS as a bank. And they're minus 15%, which is how the math works. If you're 90, 25, minus 15, and that means they have credit card debt. Credit card debt is something that I would encourage all of you to avoid like the plague. I have clients that have 200,000, 300,000. Don, you have them too, right? 200, 300,000 in credit card debt, and they survive by making the minimum payment, right? I mean, it's just crazy. So we want you to not do this. That's a good rule to live by. Rule number 2, pick a date to retire right here, right now. You're thinking, Art, I just graduated dental school. I'm 27 years old. Are you crazy? Retire? No, I want you to be thinking about the date you want to retire. Now, this isn't the date that you're going to retire. This is the date that hopefully you have the financial ability to retire, and that will allow you to go to work because you want to, not because you have to. We are all living much longer these days. I used to, there was a book written by let's see, what was it? Your Golden Years After 65, I think it was called. And it was written by a lady by the name of Victoria Collins. And basically back in the 30s, 40s, 50s, people would live till they were 65. They get their gold watch, and that was about their life expectancy. People now are living into their 80s, 90s, more than 100. So, you want to pick a date to retire and plan your retirement right here, right now. Say, I'm going to work till I'm 60. Does that mean that this isn't going to change? No, of course it's going to change. But you have a goal. Everybody that I work with who is goal oriented is much happier financially than just kind of going around and spending money and then, well, yeah, I guess I'll retire someday. So pick a date right now. Pick it, think in your mind, 55, 60. We have a dentist. He just passed away. He practiced in Anaheim Hills. Dr. I can mention him by name, Dr. Jacob Eisenreich. Dr. Eisenreich was a Holocaust survivor. He practiced until he was 95, and he passed away, I think, at 96 or 97. He came to my dental marketing seminar, Don, when he was 92. It was amazing. So he wanted to work forever. We have a lot of doctors that are working longer. So pick a date to retire. Build an emergency savings fund. So folks, many of people work paycheck to paycheck. And they don't have, if something happens, they lose their job, maybe they can pay rent for a month. Maybe they can pay it for 2 months. One of the things we'd like to encourage you to do from a financial planning standpoint is to plan an emergency savings fund, which would be 3 to 6 months personal living expenses. So let's go back to my 65, 25, 10 rule. $65,000 a year is a little over $5,000 a month. So if you had $15,000 to $30,000 in a personal living expense fund, you would have your 3 to 6 months. The reason we say 3 to 6 months is because if you have disability insurance, God forbid you get disabled, that has what's called an elimination period on it, which means that when you get disabled, you go to the insurance company. The insurance company says, okay, you have an elimination period, which means you don't get paid for 3 to 6 months. That's why you need to have the living expenses. You always want to have a cushion. You never, ever want to get to the point where you go, oh my goodness, I got sick, I broke my arm and I don't have any money. So 3 to 6 months personal living expenses in an emergency savings fund.
Hey, and we had COVID last year too, Art. A lot of people didn't have jobs for a period of time. Doesn't count as disability. So there's got to look at other sources of supplement.
That's absolutely right. Good point, Don. And then plan your retirement base. How much income do you need? Working with a financial planner, you can figure out if I want to retire in today's dollars on $10,000 a month. Well, if you're 27 years old and you want to retire when you're 60, $10,000 today, you're going to need maybe $30,000 a month. If inflation is usually 2 to 4%, that's what you're going to need. So plan your retirement base. How much income do you need? Which tells you how much you need to save. Now, again, right now, all of you are, you've got student loan debt, and this is the last thing you want to hear, but I want to plant this seed. The reason that we do these webinars, folks, is to basically make this a call to action so that you get to the point, maybe you buy a practice and the practice is doing well, and you've hired a consultant and they're really helping you get going. Now I can start thinking about retirement. Now I can start thinking about paying down my debt. Now I can start thinking about college for my children. Although what worked what I tried with my two boys who are 26 and 32 was to continue to whisper to them community college every night before they went to bed. They didn't listen. One went to the Academy of Art University in San Francisco, and the other went to Chapman. And those are a little more expensive than community college, but save for college, folks. It is expensive. Next slide, please, Amanda. Okay, so here's this 65-25-10 rule. If you make 120,000, I use 120,000 here. 65% or 78,000 a year on personal living expenses, 25% or 30,000 a year on taxes, 10% on savings. Now, when you put money into savings, folks, that could be a personal savings account, money market account. Make sure it's really secure and liquid. Don't invest it in futures or options or anything like that. You can fund IRAs. For those of you who have income that is under a certain limit, Roth IRA is great. If not, you can fund up to $6,000 a year in an IRA, etc. But get in the habit of saving money. Here's another rule for you. Your home rental payment should run about 1 week's take-home pay. Again, if yours is 1.3 times take-home pay, don't have a breakdown or anything like that. But these are just some guidelines. So if you make 120,000, you pay 30,000 taxes. That leaves you at 90,000, which is 7,500 a month. Divide that by 4.2, which is monthly, and your rent should be about $1,785 a month. If your rent is $1,900 a month, that's probably okay, but it's just some guidelines. You should be able to pay off your credit card every month in full. One of the reasons that I like the American Express card. Now, American Express has one that you can run on a balance, but for many of the American Express products, the reason I like them is you have to pay them off every month. If you're running up credit card debt, it's the devil, and you're never going to get out of it. Don, we have clients who every 3-4 years, interest rates are low. They run up a bunch of credit cards. They run up a bunch of debt. They pay it off. They do a reconciliation loan, a refinance loan. And then what do they do again, Don?
Start taking out some new credit cards or re-hitting that credit card that they already have in their pocket, and boom, starts all over again. Right,
exactly. So, and basically, until you're making more money as a practice owner, I'll tell you, everybody's got a different way they think. I am 61 years old. I have owned 4 cars since the age of 20. And I would have only owned 3, except somebody rear-ended me in a parking lot and they totaled my car with the insurance company. You know, until you're getting going, I know that you go to school and you feel like you're in prison, especially those of you who have done specialty programs. I mean, we're talking 4 years of high school, 4 years of college, 4 years of dental school, anywhere from 2 to 4 years, maybe a GPR, 2 to 4 years of residency of a specialty, and you get to your 30 and you go, I've been living on minimum wage my entire life. I'm going to go buy myself a Mercedes or a BMW. Just be careful, folks. Don't go and overextend yourself, because you know it's really going to be difficult to do that. Okay, let's go to the next slide. Get in the habit of saving money. Now, you're going to say to me, you're sitting there and you're listening to this, and you're going to say, you know, Art, I've got debt. I've got, you know, student loan debt, $2,500 a month. I mean, I live in Los Angeles. Have you checked out what it costs to rent an apartment in Los Angeles? I got a car payment. I got this, I got that. Well, you know what? Get in the habit. It's like anything else. We get in the habit of exercising. We get in the habit of eating right. We get in the habit of doing good things and doing yoga, whatever it is you do, get in the habit of saving money. Even if it's, I don't know, if it's $100 a month, I don't care. Get in the habit of saving money, no matter what it is. And if you can't, you need to maybe look at cutting some of your overhead and expenses. Take maximum advantage of tax-deferred retirement vehicles. Folks, the money doesn't go bad if you start funding your retirement at 28 or 29. Okay, the more money that you can put into a retirement plan, and as a practice owner, you can put in up to $57,000 a year into a profit sharing plan. And you can put your spouse on the payroll. So you can get up to 80,000. Now, again, for many of you listening to this, you're thinking, I'm insane. How am I going to do that? I'm paying off my student loans and I'm making $8,000, $9,000, $10,000 a month. Well, any chance you get for IRAs or simple IRA or, and we'll get into that a little bit later, use tax-deferred retirement plans. Own your home free and clear by the time you retire. So let me give you kind of the methodology that we see with most of our clients. You get out of school, okay? And you go and buy, you rent your apartment, and then you buy your first house. And the way my wife Lynn and I of 36 years were able to buy our first house, and this is the God's honest truth, folks. We were both working and living in a one-bedroom apartment. She called me one day and she says, we're going to go down and watch the TV show, The Price is Right. And we did that. And she got picked. And she won $10,000 on The Price is Right in 1986, I think it was. And that was a large part of the down payment of my first house. I would not recommend that methodology to you. But again, you know, you're going to buy your first house, probably somewhere, you know, 1 to 5 years out of college, out of dental school. Then you go ahead and you're going to live in your house. And then you're going to, what many of you will do is you might start a family. And you find that you're in your 1,500 square foot house and you have 2 children, and those 2 children are overrunning your 1,500 square foot house. So then your practice is doing well, you're making more money, and then you move on to the next house, which you're probably going to finish raising your kids in. And then you get to the point where you get older and you downsize a little bit. But the bottom line is, whatever you do, plan out so that you would own your home free and clear by the time you retire. That could be 55, that could be 60. So maybe by the time you're 35, you're going to buy the house that you're going to basically get to retirement on, put it on a 20-year mortgage or get a 30-year mortgage so you have the flexibility of the payments, and just plan on a 20-year amortization schedule. And we can help you with that, or you can go on to the internet and find an amortization program. Never invest more money than you can afford to lose. Folks, as healthcare practitioners, you are going to be approached by all kinds of people who want you to buy all kinds of products and services. They're going to convince you that a conservation easement or this type of an investment or options or futures are going to be the best investment that you can ever make. Never invest in anything more money than you can afford to lose, because I have a client who many years ago came to me. This was probably 20 years ago. And he showed me this investment advisor's portfolio of options and futures, which are very risky investments. And he said to me, he actually lambasted me because I wouldn't personally invest in this with this gentleman. And that was the end of that. And I didn't hear from him. And I went to call him to do his tax return. And I called him up and he started, and I am not exaggerating, he started crying. He says, Art, you were right. He lost $1.5 million in 3 days trading futures. It was virtually his entire retirement. Never invest more money than you can afford to lose. If it sounds too good to be true, it's probably too good to be true. Use your common sense. And if something doesn't look right, come to your CPA, come to your financial advisor, let them take a look at it and give you an unbiased opinion. All right, let's go to the next slide. 4 to 6% might be boring. Okay, that slide, by the way, used to be 7 to 9%, because 7 to 9% is the average return that equities, that stocks and mutual funds have brought in the 100 plus years that the stock market has been around. The average is 7 to 9%. And right now, the stock market is doing very, very well for lots of reasons. Our government is pouring trillions of dollars into this economy, which is basically helping to drive this up. Interest rates are as low as they have ever been. Something's going to give at some point, but the average has been 7 to 9%. I'm not giving you investment advice. 4 to 6% may be boring, but it works. Work with a conservative investment advisor. You wanna read as much as you can. Don, how many clients do we get? We get a pile of 12 investment statements when they send their taxes in. They've never even opened their investment statements or talked to their financial advisors.
It's completely sealed. Hadn't looked at one of them all year long. They just give us the 1099 and it's all we need for taxes. But yeah, they really haven't taken much interest, I think, in what's going on month in, month out with their investment portfolio.
Okay.
Yeah.
In short, 4 to 6% may be boring, but it works, folks. The magic of compound interest will get you to the promised land. Insure yourself for peace of mind. Let me just give you some quick tips on that. Life insurance. If you're single and your only beneficiary is your poodle, you don't need as much life insurance. If you're married and you have children, you need enough life insurance to do the following. You need to be able to pay off your home. You need to be able to have a fund that will allow your 2 children or 3 children or how many ever children you have to go to college. And then you need another fund that is going to give your surviving spouse, unless they are working and making a very good income. If it's a non-working spouse, you need to have enough money to give them a pool of funds that they can continue to live their life and raise the kids. The number I'm going to throw out to you for life insurance is $3 million at a minimum. And that is what we have found. So if you have $500,000 or $1 million and you're married and you got a couple of kids and you're 32 years old, you might think about getting more. It's much cheaper to buy it when you're younger. What I did is I didn't buy permanent insurance. I bought 20-year term insurance. So I bought insurance. I had $1.25 million on myself. 20 years, my premium, I got it when I was 40. And the plan was that by the time I was 60, I had enough money saved that I didn't need life insurance. And so when I was 60, the premium went from $2,100 a year to $21,000 a year. And I said, no, thank you. And I canceled it. So that's one way to look at it. Don't make and disability insurance, folks. How much long-term disability insurance do you need? As much as they will sell you, period. It needs to be non-cancelable and guaranteed renewable. Okay, don't make your home into the money pit. Now, many of you who are listening, assuming that most of you are younger, young dentists, there was a movie that came out, I believe, Don, in the 70s or the 80s.
I'm gonna go 80s.
It was the 80s?
I think
with
so.
Tom Hanks, who you all know, and Shelley Long, who was on the TV show Cheers. It was called The Money Pit. If you ever want a good laugh, watch the movie. Get it on Netflix or wherever. It's about a young couple who bought a house that was a money pit. They kept putting money in. Things kept going wrong. Don't make your home into a money pit. Someone is always going to have a nicer house than you are. Again, houses are a place to live. Some people think of them differently, but that's your decision. Okay, I'm of the opinion, buy, don't lease a car. I told you I've owned 4 cars since the age of 20. I buy a car, I keep it for a long time, I maintain it, I take it in for service like clockwork. And, nobody comes to me and says, oh, well, Art, you're not successful because you don't have a 2021 Mercedes S-Class. I have a 2007 car with 206,000 miles on it. It's a very nice car and it runs just fine and it's all good. So that's my opinion. If you're the type of person who wants to have the newest model of car, then maybe you should lease a car. Just understand you're always going to be making a $800,000 a month payment. But at the end of the day, folks, you are dentists, you are successful, you are at the top of the class. You don't, in my opinion, need to prove anything to anyone. Okay? If you don't drive the fancy Jaguar, Bentley, Mercedes, whatever it's going to be, nobody is going to think anything less of you. I'd rather see you take that extra money and put it into retirement or your kids' college education. And the last thing is plan your estate to help the people that you love. And folks, you need to have estate documents. Very, very important that you have those in case something happens to you. You can know where everything is going to go. I will tell you that I have some of the harshest meetings I've ever been in at all. Okay. One of the harshest meetings I've ever been in have been between family members after mom and dad have died because they're fighting over the money, because there were no estate documents and it was kind of like up in the air and we had to get attorneys involved. So plan your estate to help the people that you love. Let's go to the next slide, Amanda.
We can pause. We can pause there because I'll get into this here in a second. I saw a couple questions come through.
Okay.
One was about the type of insurance that should be bought. Someone heard that life insurance is a prerequisite for buying a dental practice. It doesn't matter that if they get a $2 million policy for their first practice and cap it at $3 million when I buy my second. So can you kind of speak to, I know you've done some practice sales and probably know what maybe the banks and so forth might recommend or suggest or require.
Sure. Great question. And for those of you that are buying practices, most of the banks will require if the loan is over a certain amount, and it's bank to bank. Some banks require it, some banks don't. Most of them do. They will require insurance to cover the amount of the loan. And what you want to do is you want to buy what's called decreasing term policy, which means that every year the amount goes down because as you continue to pay the loan down, if you buy a practice for $800,000, 5 years from now, you might only owe $450,000 on it. Well, you don't want to still have $800,000. The cheapest insurance that I know of is through the American Dental Association for a practice. And it's through Great West Life Assurance Company. The premiums are like really, really good. They've been in business for 120 years. So you want to find for your dental practice the cheapest. This is a commodity, like the textbook definition of a commodity. So that takes care of the practice loan, and that will be up to the lender. Most of the lenders will require life insurance to cover the amount of the loan. And again, we have insurance people that we can refer you to. Neither Don nor I sell insurance. As far as the life insurance for yourself, as I mentioned before, maybe $3 million of either a 20-year term or permanent. If you're younger, buying whole life insurance is actually a good deal because you do build some cash value in it, and it's cheaper when you're younger. So I hope that answers your question. Was there another one, Don?
I had another one that came up. This is along the lines of disability. So if somebody got to be 65 and at this point, as you mentioned, was working because they chose to versus because they had to, is there a certain cutoff point that it makes sense to stop doing disability insurance? Right. Maybe in this case, an age because you've hit Social Security possibilities and stuff?
Great question. So when I started practicing as a CPA back when the dinosaurs ruled the earth, I bought long-term disability. and they were for life. The policies, they would pay out for life. The insurance companies have gotten much smarter in their old age, if you will. So if you now go out and buy most disability policies will end at age 65. Okay, so you want to buy disability, and the hope would be that by 65 you don't need it. That's why you want to plan your retirement base and fund your retirement. But most disability policies that I'm aware of will end when you are 65 or 70 or something like that, because the insurance companies, they control the product. They kind of have a monopoly, if you will, and they can save themselves, because remember that way back when, in the 60s, 70s, 80s, people were not living as long, so they could give a lifetime benefit, and it was attractive to sell the policies. Well, now, if you're an insurance company and you get to 65 and I have a lifetime benefit, you might be paying for another, realistically, 25, 30 years, 35 years. So that's why they've done that. So, all right. So what we're going to do, maybe Amanda, try and turn control over to Don. Maybe his computer is smarter than mine. So Don is going to take over, and he's going to chat with you about independent contractor, employee, and a lot of the financial issues that you're going to deal with, either as an associate dentist or as a purchasing dentist. So Don, take it away.
Will do. Unless Amanda's fine for controlling it. I always do appreciate your golden rules, because I get to that retirement part and it grounds me a little bit to remind me that Mega Millions and Powerball is not a retirement plan. So I think I got that from my dad, but oh well.
I want to meet the guy that won the $1 billion. I think he's in Michigan, or she's in Michigan.
Oh, that's true. I did hear about that number getting that high, but didn't hear it was one. So how cool.
Yeah. Don't play the lottery. So, okay.
All right. So as Art said, what I'm going to touch on here is this is going to be as you operate as a dentist. We're going to talk about, some aspects of being an employee, some aspects of being an independent contractor. We're going to talk about how you keep track of records, what an S corporation, how that might fit into all this. So let's start here with the advantages, disadvantages, and you can kind of depends on who you are in this scenario of what's whether it's an advantage or disadvantage. But when it comes to be an employee, you have taxes taken out of your paycheck each time you get paid. Now, the bad part is, at that point when you've earned say $2,000 that week, $3,000 that week, you're taking home $3,000 if you're an independent contractor. But if you're a W-2 employee, you take home less. So a disadvantage from that standpoint. However, at some point, somebody's going to pay the piper on the taxes caused by that income, which means when you get it taken out little by little, it doesn't hurt as bad as maybe doing it every few months or at the end of a single year. Also, part of the taxes that come out of your paycheck are going to be Social Security taxes. Actually, they call it FICA. It's composed of two parts. Social Security is one at 6.2%, and the Medicare is 1.45%. So when you're a W-2 employee, then you only pay the half that the IRS needs. The other half is on your employer, so advantage you. And then also, if you're an employee, and this is where you get a little bit of fight sometimes from the person that is paying for your services. But if you're in there as an employee, then a lot of times you get to fall into a lot of the benefits that he offers the rest of the employees in his practice. So you could be looking at things like health insurance, retirement, the workers' comp insurance, legal protection, all those things that fit under the umbrella of the business versus it being something that falls onto you. Next slide, please. So as a W-2 employee, there were some new rules passed in 2017. There was a big tax act signed in December of that year. And beginning in 18, there was a piece of the individual income tax return that took away the ability for you to deduct expenses as an employee. And that was on a section of a schedule called Schedule A. And down there is where you could put things such as your car, dues, supplies, other education, all those types of things that fell onto your shoulders. Well, when the time came to implement this in 18, nobody had an avenue for deducting those things that were on you to pay. So when you see things in this next point, like the malpractice insurance, where do you go? So what we had talked about to a lot of our employee clients was that if you can go approach your employer, that there possibly would be an opportunity that instead of maybe them paying you that $100,000 a year, like Art mentioned, then maybe you can make an arrangement that there's certain expenses like these ones above that they could pay for you directly through the business and instead pay you something less, ergo a tax deduction. It just didn't have to happen on your personal return. It was just something that the business did prior to paying you. Let's see what else we got going on here. Time plan. W-2 employee. So when you are filing your tax return, if you aren't involved in a retirement plan, then one of the only things you get to do on your personal return is to take care of your retirement through a Roth, which is non-tax deductible, or a regular traditional IRA. And currently that number's at $6,500. So when Art was talking about numbers in the neighborhood of, $20,000 in a 401k or possibly $57,000 if you're into a profit sharing plan, you have a much smaller availability when it comes to taking something of a retirement nature on your personal tax return. Next slide, please. We get a lot of questions on this topic. I probably answered 2 of them last week alone. And most of the time it will come in respects of somebody calling into us and saying, I just am getting ready to start my career and I've got an offer to work as an independent contractor. What does this look like for me? How do expenses work? Do I need to do an S corporation? And we're going to get into all these. So this is where the independent contractor part is, need to have a discussion with somebody that can describe how these rules play out for you. And as Art said, there's going to be some legal ramifications to it. But in short, when it comes to the, to the tax side, one of the things that we look at a lot is there was rules from years ago that directed how this person would get treated inside of a business. And those are really rules that the employer is to follow. And then California as a state got additional information a few years back and said, this is how you determine whether somebody fits the mold of an independent contractor or employee. And then recently, probably towards the middle of last year, they said, no, we're going to scratch that. Dentists have an exception along with some other parties in different industries, and we're going to fall back to the normal rules, which are the IRS rules from years ago. So we've been seeing a resurgence here of different practices bringing in people either as an employee or an independent contractor. If you're going to get money as an independent contractor and you are not incorporated yet, you will file a Schedule C. And Schedule C will just be an extension of your personal income tax return. So it's a schedule that will allow you to put the income on there as well as any related expenses. And when you have that happen, now you've got an avenue opened up to you that will give you a retirement possibility beyond just a regular IRA. You can have a SEP IRA as you see here. You might do a solo 401k plan. You could also do a profit sharing plan combined with the 401k. So there's other avenues to really jack up and kickstart your retirement other than doing, $6,000, $6,500. One of the downsides though of being an independent contractor in that setting is going to be now the self-employment tax, as we talked about earlier, FICA, so Social Security and Medicare, but now it's not just half, it's the whole amount. So you'll need to incorporate those together, and that's all on you to pay out of the money you've earned. Employee benefits, as we talked about, without being an employee and possibly having that being paid under the tab of somebody else, you now have to go seek those things out if you desire to have them. So having your own health coverage, whether it's for you and the family, whether it's the insurances and all the other things that go along with being an employee, again, are now you're your own employer, so to speak. Health insurance, again, there's kind of a couple different ways you can deal with health insurance on your personal return. If you're married, you can look at employing spouses in there to give some better deductions, but by and large, it's a deduction that occurs at the personal return level. And taxes, you'd need to be wary of this just because, again, you get so used to bringing in money every time you get paid, you got to set those dollars aside. As Art mentioned, the 65, 25, 10 rule. If you don't put these dollars aside, you're going to find yourself in a real bind come tax return time. I've seen a lot of returns get filed and a liability comes up. It might be $23,000, $34,000, whatever, the case might be. And it's a shock. Nobody has paid quarterly taxes. They haven't saved up along the way. And it's a real tough hole to get out of. So as we mentioned, whether you want to shave it down to weekly or monthly or some other, time frame that makes sense, you can set dollars aside, and then working with your CPA, they can put together tax estimates for you so you have something to shoot for every 3 months. If it's $5,000 a month, you save it up, and then at the end of the quarter, you pay $15,000. It gets the ball rolling so that you don't get behind on your taxes. Next slide, please. So as we mentioned, the W-2 side, you're going to have your federal and your California taxes taken out of your paychecks versus having to set money aside each period. I think we've covered a couple of these first ones here. On point 3, this is happening a lot. You get hired when you come out of school, and you may not have a practice that needs you full time, and you could operate at 3 or 4 different practices. Well, each practices may not view you the same way. They may have made some determination. Either it's either legal or it's going to be a gut feeling. How do I want to pay this person that is working for me? So the same person doing the same thing at 3 different practices, you might be a W-2 at 2 places. You might be an employee at 1 or an independent contractor at 1. Problem is, if you get the wrong mix, you get to the end of the year, if you're still not wary of how much money you're bringing in as an independent contractor, you could get behind on paying in the proper taxes. So usually here's where we, again, we'll sit down with somebody and sketch out, what are you making as your employee side? How much taxes are coming out? Where are you going to be at the end of the year? Is that enough to absorb the money you're making as an independent contractor? Because if not, it may need to be supplemented. So just because you have some W-2 income, you don't want to find yourself in a situation where there's not enough there to take care of the independent contractor side. In a lot of cases, what happens is if you're making $30,000 here, $40,000 there, $20,000 there, those payroll systems, the 2 that are having you as employees, may not understand how much income you earn. So as you're climbing up the tax brackets and you owe more on those dollars that you earn later on, you may have a lower withholding in 2 places, and it's not going to be nearly enough to take care of your total tax liability in the end. So as you see these things develop, always recommended to sit down with a tax person and at least give some thought to what do I need to do earlier, middle of the year, versus getting to November, December, or even worse, March when you file your return and then find out you were short. Next slide, please. So here's an example we put together. This goes back to a person that makes $120,000 under 2 different scenarios. And in the old days, with the way the laws were, we probably saw a little more discrepancy when we got to the bottom line on the tax liability. But because there was a couple of things added in here that we'll talk about here in a second, the numbers actually come out fairly close. But as you'll see going down here, the person that's an independent contractor writing off some expenses, both will receive the same standard deduction. But then you notice this item called 199A. And this was part of the same tax legislation back in December of 17, that as they changed the tax brackets, or the tax rates for corporations, one of the things that was considered was, what do we do for those who are not corporations, those that have partnerships, those that are sole proprietorships? And they said, we're going to come up with a number that will allow them a deduction that equalizes this and makes everything in parity. And that was 20%. And so 20% of the net income of your business can be taken as a deduction. And that's why you have it here, not the employee side. And then you also get to deduct self-employed health insurance, which you don't get as an employee. So while you can see that the taxable income is quite different between the 2, what you have though is while the income taxes are lower for one, you also have to take care of the Social Security and Medicare taxes as an employee and employer, those both halves again. And when you add all that together, you end up around a $28,000 number as far as the tax liability. Two different paths to get there, but in the end, you just have to have be cognizant of the things you need to do from one side versus the other to make sure that you're prepared for each of those $28,000 liabilities. Yes.
Don, let me jump in, and I want to
Yes.
make a comment for those of you who are just getting started about the difference between an effective tax rate and a marginal tax rate. So, like we were saying, we have what's called a graduated tax rate system. So, for example, for a married couple, I think the first $18,000 of income, you pay tax at 10%. And then from 18 to I think it goes to maybe 80,000 or 40,000. I remember the rates, 12%. Then it goes up to 22, 24, as high as 37% if you, as a married couple, make $600,000. So when we talk about your marginal rate of tax, this particular doctor is usually in about a 22 or 24% marginal bracket. That means every additional dollar of income that you earn is going to be taxed at that rate that you're at in the marginal rate. But at the end of the day, you take the total amount of federal income tax you're going to pay, divided by the amount of your income, and that's your effective rate. So because this particular doctor under independent contractor got so many deductions, they got the expenses, the standard deduction, the 199A, which is big, and they get to write off their health insurance. They're only paying tax on $74,000. They're paying more Social Security tax, but their effective rate, their taxes, $10,000. So they're only paying an effective rate of somewhere in the neighborhood of about 9%. The employee doctor who really doesn't have any write-offs, but doesn't have to pay double the Social Security and double the Medicare tax, is going to have an effective federal income tax rate of, it's going to be pretty close because they're about the same. But, again, you're paying more Social Security tax. So just be aware when someone says, well, what tax bracket are you in? Well, you're not in a 50% tax bracket, folks. You're in a 50. If you make more than $600,000 a year, you're in a 50% tax bracket. California's maximum tax rate for most of you is going to cap at about 9.3%. Once you go over about 500,000, it's 10.3. And then over 600,000, it gets to 11.3. And if you make over $1 million, it's 13.3, which includes a 1% mental health tax to support the mental health system. I don't make this stuff up. So if you're making $600,000, $700,000, $800,000 a year, you could be in a 50% marginal rate. But for most of you, you're probably, for every additional dollar you make, you're probably earning under the current tax structure, that's somewhere around 30, 32%, Don. Does that sound about right?
Yeah, I think that's right. And I think effectively we see a lot, when you start looking at the numbers of the doctors and the clients we serve, it's usually somewhere between like 18 and 24% total effective rate.
Okay.
Would you agree?
Yeah, that's about right.
Yep.
Again, it depends. We have doctors who make $1 million a year and don't give anything to charity. We have doctors that make $300,000 a year and they give $50,000 to charity. Charity is going to help your taxes. I am very, 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 very careful when I talk to someone about charitable contributions. Charitable contributions are a very personal thing to every human being. So I will never say, well, why aren't you giving more to charity? I mean, I will always say, and Don will do the same, doctor, if you give another $10,000, this will save you X amount. It's up to you. So it's a very personal thing, but if it's something that you like to do, it's going to cut your tax bill. So.
Agreed. Thank you. Next slide, Amanda, please. All right, we kind of hit on this one a little bit earlier, that if you are working with another practice, how can you maybe shift the inability to deduct certain things that fall on your shoulders to somebody else? And then this would be the strategy, would be working with the business to see if they could at least give you some allotment or work on certain types of expenses, and then coordinate through the overall net pay to you. And maybe let's say, a monthly computation. They'll take out whatever that you've instructed them to pay, and then they pay you the net difference. So that's one thing to look at. The individual retirement accounts, Art and I hit this a couple different times. You really got to give thought to what is it you're looking for. If you have the ability to put money into a traditional IRA, and in most cases, as long as you're not involved in a plan, you can still make $250,000 and still take a deductible IRA. But a lot of times the investment advisors will give discussion to, do you want the deduction today, or would you rather have the tax-free money 30 years from now? So you want to put $6,000 in, and then maybe in 30 years it's worth $150,000 or something, depending on how many times you put it in. But with that growth, that's free money there versus just the deferral of tax to somewhere down the road. And so that's a consideration. If you're an employee, then take advantage of the 401k plan that's offered to you. If it is eligible, you do want to do that. A lot of times there might be a matching part that's there, and you need to put in a certain amount. So you always want to make sure you can get whatever you're able to from the benefits offered by the employer. If you're an independent contractor, then you want to go for the SEP IRA, and that is a pretty easy setup. Those are things you can do with your investment advisors. There's other plans out there that require different paperwork and different filings, but when there's no other employees in your business, then the consideration for the SEP IRA does allow you a pretty nice contribution, each year. Automobile. Now, again, as Art said, it really depends on what you're spending on your automobile. If it's an older car because you want to be conservative in car payments and the cash that you're spending, you may not have a huge deduction from an actual expense standpoint. But perhaps from a mileage standpoint, then you've got something that you can place on the return and gives you a pretty sizable deduction. If you're leasing your car, then your lease payments as well as the operational costs are going to be deductible. What you always have to keep in mind is business use. Just because you have a car payment for $500, we'll say a lease, and you've got $100 a month in gas and insurance and all those things, that number by itself is not going to be the full deduction. You can only deduct, per the IRS and all state rules, what is business. They don't want you writing off things that you use for commuting and other personal aspects. So it's always important to keep track of the mileage for those kinds of things. That way you have a way to go and defend yourself and support yourself for that deduction.
We're going to get a little deeper into the weeds, folks, as far as car goes when we get to the slide where we're talking about deductions for practice owners. So we'll hit this a little later.
Okay. As you're preparing your return, giving consideration to itemized versus standard deduction. Standard deduction was another area that was altered with the tax legislation back in the end of 2017. And so it's around $12,500 per person, $25,000 up or $24,000 area if you're joint, but it's possible you could itemize. And so as Art said, you got to give thought to everything that goes on to the itemized deduction form and where you might fit in there. You have taxes, you get up to $10,000 there. Perhaps you already are in a home, so you have mortgage interest. That adds to that mix. And then you have donations. Those are going to be your three primary areas that could get you over that number. So you want to make sure that you're using the consideration of which one's going to be a better one for you. If you're getting very close on itemized deductions, and you've got some control over things, again, such as donations, you really don't have control over your mortgage interest because payments are due when they're due, and taxes are still limited. But when you have donations, you could always give thought to, well, if I'm going to give $7,000 this year to overall charities, but I'm going to do the same next year, perhaps you can delay it a handful of weeks and then bunch them up into a subsequent year. That could offer you a higher number to deduct than the standard. So those are kinds of things we'll have talks about with our clients as well. And the last item is this a lot of times will come from just having good old-fashioned one-on-one conversations with our clients. And we do a lot of this at the end of the year, and it's called our time that period called tax planning. And from usually the end of October through the end of December, we'll sit down and go through the businesses with each of our clients. How does the business information, the net income, fit into their personal tax return? That's the area. The personal tax return is where most of our businesses will pay their tax. And we'll play out some scenarios. We'll look at, what tax bracket they're in. We'll see how short they are of tax, on overpaid on tax, and then we'll just talk about life in general. Well, this particular situation, we were sitting down and we had learned that he got engaged, and he was giving thought to and telling us that, yeah, we were going to go get married around the first week or two of the subsequent year. And we said, let's just run some figures. So we decided to consider him married, and also turned out that the person he was married had other children, which aids in having dependents. So we run the numbers, and it turned out if he got married just 3 weeks earlier, he saved around $13,000, $14,000, $15,000. It might have been 20 with state. So having this hearty conversation, a few days later, he went to his fiance, decided to have a wedding, just a ceremony in town before the end of the year, and then he filed as joint by the end of that tax year, which saved him, close to this number versus what he would have had otherwise. So those are just the kinds of things that having hopefully somebody else involved in the process to talk through some things, hear what's going on in your life, what's going on with the business, can point you in a direction to make it worth the the cost of having a CPA and involved in her. Next slide, please. All right. So along with the operating as a W-2 employee or a contractor, we hear what happens, if I am an independent contractor. How should I get paid? Should I have a corporation involved? And the person I talked to a couple of weeks ago, she had came to me and had a similar question and already formed a corporation, was right in the middle of doing it. So we talked through a little bit about how was she going to work with her employer? And she explained. I said, "What are your plans going forward?" She kind of told me what her plans were for the next 3, 4, 5 years, how she might want to be or not want to be a practice owner. And we got into the issues you see on the screen. So what we primarily will tell the people that we work with or the prospects that are having these conversations, if you are not looking to be a practice owner anytime in the near future, it probably doesn't make sense to have a S corporation in there. The corporation has inherent cost to it. You've got to get an attorney involved. You've got to pay cost to the state to get incorporated. There's going to be cost to the state for annual maintenance of the return. And then there's cost to us as accountants to help you file the corporate tax return. Now, the reason we have S corporations in many cases is to assist with, if you receive this money in a corporation, can we not have all of that money paid out to you subject to self-employment tax, being the FICA and the Medicares? And if we can do that, there could be a chance for some tax savings, $300,000 a year, but you only take out a salary of half of that, and the other half is just income taxable, but not subject to payroll taxes. That could save you $3,000, $4,000, $5,000. So having a corporation in there for that, and it's a couple other things, is certainly a benefit. But when somebody is going to work for maybe $150,000, $200,000 a year, there is not a lot of wiggle room to make the corporation of a big benefit. All you've done is taken on the burden of additional costs of having it there, setting it up, the filing costs and so forth, but the chance for saving a lot is just not available. So we typically will shy away from suggesting that. So if you incorporate and working at 2 jobs as an independent contractor and you stop working at one of those and W-2. All right, yeah. So this goes back to the same as the previous comment, that what do we do at that point? So we do want to have a conversation. If the employer decides to switch you over to being an employee versus being an independent contractor, and therefore you've lost that value, then we do want to talk about what are your plans in the coming years, because all you're going to do again is have these additional costs, but perhaps not the benefit. So before you shut it down, we will have those discussions with you, but certainly worth the talk. Let's make sure I covered that one. Yeah, so the fourth point, having a labor law attorney for the ramifications of forming the corp. Yeah, we see that the attorneys will jump in there a lot to give you the advice of that. But we do find that the person that's paying you, that's really where a lot of this will fall back on. They're going to have to evaluate based upon the IRS laws and the state laws. Do you qualify? Because they will be the ones that have their hands slapped if they are not doing you right. They will hear from, say, state agencies or federal agencies that they have misclassified you. They will take them back to paying all the employment taxes. So they're the ones that have to be especially cautious as they classify you as one or the other. But if the corporation thing, again, was at the forefront of your mind as being something you wanted to do, then we would typically wait, if you had not gone down that path yet, then waiting until you get ready to buy a practice, so that as you become ready to do the loan work, doing the paperwork on the purchase, then having that available to us to do all the transactions through. Otherwise, everything starts falling under your personal name, and then that screws up exactly how we want to form the business, the practice down the road. Anything you wanted to add there, Art?
No, like I say,
Okay.
we normally don't recommend that you set up a corporation until you're ready to buy a practice. A lot of people think it's glamorous and it's really cool, and it's just a lot of work. It's accounting fees, it's legal fees, it's $800 a year to the state of California. So again, unless you're pretty darn sure you're going to be an independent contractor for 5 years, you might want to consider this, but not setting it up, but talk to an attorney, because we do not give legal advice. So
I think we hear a lot that it's usually, one of my colleagues had mentioned this, where the other people I've worked with have mentioned doing it to get a corporation, and they will get a lot of their advice from the people that they know in their dental community. But again, it really depends on a lot of different situations. Again, they're thinking back to what somebody else has done. That may not always be the right answer for your situation. So getting somebody else's input outside of that would be worthwhile. All right, next slide, Amanda. All right, so how do you incorporate? We get this question a lot as well. Where do I start to get this ball rolling? And I usually pump the brakes for a second. That the first step to becoming a corporation is a legal process. You file with the Secretary of State the articles of incorporation, and those are articles, a legal document, again, that's drafted up by an attorney. I think in some states you probably have the ability to do these 1 or 2 page deals and pay the fee yourself. And there's always the, those legal, what's that one, Art?
Legal Zoom.
Legal Zoom, places like that can get those going. And it doesn't mean it's the end of the world, but I normally don't want to risk my livelihood of being filed properly or getting the potentially advice that could be useful, from, saving a few $100s. So you'd want to go through the attorney first. Where we come in a lot of times is right after that step to help file the S election. We will help do, and that's down here further, doing the S election and getting your federal ID number. Yes, I was looking.
Yeah, we want to do the S. The S election can be made by the usually the accountant. Within 75 days you incorporate. You should all be S corporations. Very, very rarely will we ever see someone stay as a C corporation. So
yeah, and the process for getting incorporated does take a little time. There are ways to expedite the process. It just depends again on what your needs are and what you're wanting to pay to get things done timely. Sometimes you've got a purchase that's hot to go, and you really need to have all these things in place because the bank's wanting to assess everything and got to get the paperwork drawn up and whatnot. But by and large, you want to give yourself some time. As long as you're going down that path, then you want to secure an attorney to work with you on getting things put in place, but hopefully never under the gun. All receipts that you get in the corporation will be a corporate bank account. So what you want to make sure of is that we don't loosely keep track of our accounting and the cash that goes in and out. It's easy to do when maybe you're an independent contractor and just being a Schedule C, in that you are one and the same taxpayer for purposes of the IRS. But it's even at that level, we recommend, if you're doing this for profit and you do need to have a reporting of what you brought in and what you paid out to the IRS and the state government, then having a separate bank account, even at all these levels when you're running a business, is preferred.
Don, you want to take a couple of questions?
Oh, sure. What'd you find in there?
Yeah. Well, I had just one from my starting the lecture. Do you suggest buying a lifetime rider on disability insurance policies? Riders are how insurance companies make money. I like cost of living riders on a disability policy because it covers inflation. It just depends on the rider. Usually those are about the only ones that I'll tell you to buy. So now, and more to what Don was talking about, husband and wife who are a dentist, do we need to have separate S corporations to open up a practice and have a partnership? Don, I don't think we do that for a husband and wife. If we're talking about two friends who are dentists, that's one thing, but we rarely do we set up two S corporations for a husband and wife as a partnership, right?
Yeah, one of the standard formats that we see a lot, if you have two unrelated parties that want to practice together, the partnership of S corporations seems to work best. When we see two or more people in an S corporation, there's just issues there of admitting other people leaving, this whole sales process and how the taxes work. So a partnership just makes, at the practice level, makes it more practical. But yeah, I would agree that if it was a single location practice and the husband and wife were both the dentist inside of there, then yeah, I wouldn't see any need probably to start setting up multiple entities in that situation.
Okay. And then if you retire and sell the practice and you stay in the practice as a very part-time dentist, how long should you stay incorporated? I guess it really depends on what you mean as a very part-time dentist. If you're making $30,000 a year, $40,000 a year, might not make sense to have that corporation. It's going to cost you $800 a year for the California franchise tax, plus it's going to cost you the cost of doing corporate minutes and the Secretary of State filing and all that stuff.
And us.
And us, yep. Us is important. That's
yeah.
Right. So, but if you're going to be working and maybe working in one office, maybe two offices, making a good amount of money, you want to still continue to write off your, write off your health insurance and write off your malpractice and your dues and CE. Then I see no reason. It's on a case by case basis. All right, let's. I want to make sure we cover all the material, Don. So let's move on.
Okay, sure.
So next slide. Okay. Yeah, let's go through this quickly.
Okay, so this was just a quick S corp example where Art's got me making $300,000 in my first year as a dentist.
He's a smart guy. He can make $300,000.
Or I can earn it as an independent contractor. I got certain expenses. So I got a profit of $250,000. So this was a point from the previous slide, but what we try to do is when you have an S corporation, one of the issues that comes up a lot is reasonable compensation. And this is, again, the purpose why the S corporation would come into play a lot of times. When you start having $300,000-$400,000 of net income, if you cannot put everything out as wages, then you start getting away from payroll taxes, which are additional costs. So in this situation, this is where, what would our recommendation be? Typical rule of thumb for us is usually around 50-50. So if I was making in this practice $250,000, I would take a salary out of $125,000, but then I would also have $125,000 or the other $125,000 would come to me in the form of what's called distributions. And that is just the recognition that the bottom line net income of the practice after my wages, my salary, is a net profit. It's an investment. So my return on that investment is paid out to me in the form of distributions. But that gets away from having to pay the payroll taxes. But I do have to be cognizant, though, somewhere along the way, I'm going to pay tax on $250,000 of income. And either I got to do it through that, half of that being a W-2, or I need to make some other accommodations with regards to estimated tax payments. So, and in a lot of cases, we also have to look at, one of the things with reasonable compensation is the fact that the IRS will also look at where are we at from our Social Security wage base. And right now that's jumped up to, I think, 144,000 and change. So in many cases, maybe in this particular scenario, maybe my wage would be 145 and my net income would be, the balance of that, the 105. So, but those are the types of things we would look at to see if we can balance all the issues with compensation, taxes, retirement considerations, and so forth.
One thing you don't want to do, folks, whether you're an independent contractor or a practice owner, is to earn a bunch of money and take zero salary. There, you're almost guaranteeing that the IRS is going to come after you for payroll taxes. So, if you want to take 100,000, they'll probably leave you alone. If you take 10,000 or nothing, they might come after you. Okay.
Right. Okay, Amanda, ready? All right, so you're a corporation, you're a business. What do we do now? What's your responsibility? And so we use QuickBooks a lot. And in the world of having to be responsible for your own books and records, and again, Art and I have worked in this industry for, I've been almost 30 years and Art's over a little bit more than that. We have seen records go from paper, filling out journals and ledgers and adding things by hand, to go into spreadsheets. Now we're in the cool phase of automation. And just like all the cool toys and automation that you see in the dental world, they're all meant to be more efficient and help you be more accurate in the things you do. Well, that's why we have financial software. And QuickBooks is the main one that's been around probably for 25 of my 28 years of practicing. And it seems to be at the forefront. You might have heard of others. There's Xero and there's FreshBooks and there's Sage. But by and large, QuickBooks has the most biggest corner of the industry as far as we know. So that's one thing you want to give consideration to, is having a software to use to help you keep track of your books and records and work with your accountant. Reasons we have it, there's the speed of it. Certainly having to do things in any of the other ways would take a lot more time, and certainly time is valuable to all of us. So finding the right program to get through these things quicker. It's also going to save costs, because whether it's your time or somebody else's time, let the program do the work. And then just sheer accuracy. Doing things with spreadsheets, with formulas and whatnot is probably not going to give you the best outcome versus paying something like this that might be $300 a year. Why do you need to do it? Well, we have a number of things. First is tax filing, especially in the area of corporations or even just being a Schedule C. You have the responsibility every year to report to the IRS the income you made, and then hopefully having the expenses, the valid expenses, to offset that and bring that number down as reasonable and legitimately as possible. So having these books and records to help you and help us put these returns together is very crucial. And then not just us, but from a management standpoint, you'd want to have a place to look of how well is the business doing. You could run reports, look at your net profit on a monthly, quarterly basis, compare quarters, compare different periods, and look at your expenses, certain line items compared to your revenue, and see, hey, how well am I doing? Is my supplies ratio keeping in line? What does my hygiene maybe look like compared to the rest of my revenue? So it's a tool to manage your business. And again, not having it in a form like this is certainly not going to be available to you. How does this all work? Well, either you can do it yourself, and I'm sure Art can attest to that. We have a number of clients that the owner, if they have time, maybe on their Fridays off, perhaps if they're not at full schedules yet, they will be their own bookkeeper. Many times the spouse does it. Sometimes it might be an internal person like an office manager. You may very well just hire an outside bookkeeper, someone down the corner that does this for a living, and you give them the information monthly and they put it in, create your books and records. And then there's other times that we are that person too. We could be the bookkeeper and the accountant and the tax preparer and consultant all under one roof. So it's just depends on how you want to get that done. But a lot of times people will look at the cost and availability to get that done. Next one, Amanda. All right. So when we step in here as from an accounting standpoint, as their CPA, what is it that we do from the QuickBooks part? And what we try to do is we get you kickstarted. So once you've done the incorporation and we get your federal ID number and you got the S election, next is, all right, I got a bank account. What do I do next? Well, the accountants will come online and get you that QuickBooks, typically your QuickBooks Online file started. We'll get all the specifics put in there. We'll get you a chart of accounts so that it's tailored to your industry, maybe in an arrangement that makes the most sense for you. We belong to a group of other CPA firms called the Academy of Dental CPAs, and we get to hear a lot of input from our colleagues about what's the kind of financial information that seems to work great for your clients. And so we can group things and put things in a certain order that hopefully gives you the best feedback. So we will make that happen. If we're not the bookkeeper, we will review the transactions you put in. And so we'll look at those transactions, do the cleanup, make any entries to tie in loans, adjust depreciation, make sure supplies are in the right category, not sitting under advertising or something. And that way it gives you the best information for evaluation. And then we could also produce reports. Those reports could be for us for tax planning. It could be for consulting about, how well is your financial picture, this quarter compared to last. It could be for your decisions to decide on how well the practice is doing, all that in conjunction with your practice management reports. And then when it comes to how do you typically access something like this? Well, anymore, everything's either going to be desktop version or it's going to be online. And a lot of the ancillary softwares we like to use for purposes of doing things beyond just financial statements seem to be more attached to the online version. So if we can get everything there, then you and us and your bookkeeper and these other softwares that can add value, they all seem to connect a lot more seamlessly from the online. And in many cases, that's, a cost there would, could be something like $15, $16, $17 a month. But that's about how the QuickBooks rolls out.
Okay.
All right, Amanda.
All right, so I'll jump back in here for a little bit, and Don, you and I can go back and forth on this.
Sure.
Rule number one, folks. So those of you, we've been spending a lot of time talking about dentists who are maybe independent contractors, don't own your practice. So you're going to go ahead and buy a practice. Now, I have two hats I wear. I am a dental practice broker, and I'm also a dental CPA. So I see both sides, buyer, seller. So if you're going to go ahead and buy a practice, rule number one, okay, from an IRS standpoint, report all of your dental practice receipts. Don't take cash and put it in your pocket. Don't take checks and put them in your pocket. If you get audited, and Don and I have been through many audits of not only dental practices, but other businesses, it's generally a 2-day audit. Day number one is nothing more than a bank account reconciliation, because the IRS knows that they're going to get the biggest bang for their buck with unreported income. There's probably well over, a couple of $100 billion a year in this economy that doesn't get reported as income. So what you don't want to do is you don't want to come to an IRS audit and find out that you didn't report your income. Report every dime of your income without exception. Now, if you're going to get aggressive on your taxes, okay, go ahead and get aggressive on your taxes through the expense side. My favorite conversation I had with a client, and it's a dear client I love, has been a 35-year client. They came into the office one day, and I'm looking at a check in the check register. I'm doing the planning, and it says $5,400 and change to Greatest African Safaris. Now, you have to send me to an IRS audit, folks, so that I can have a straight face. I'm trying to think, and if any of you want to put in as a question or in the chat or something, what you would tell an IRS audit if you had a check that you wrote to Greatest African Safaris and how it was a business expense of your practice. If you've got a good answer, I'd love to hear it. But the point is that you just want to be careful. I had another one. It was $9,000 for his hair transplant. I mean, I can't make this stuff up. So the bottom line is, report your income. Don't take cash out. If you write off an expense through the practice, that the CPA, now remember, if you get audited, guys, all right, here's the deal. You're not going down. We're not going to let you go down to the IRS with us. We're going to go down for you. I got to be able to sit across the aisle from the table from an IRS agent and to be able to explain this deduction with a straight face. Because if they start seeing that you're writing off the kitchen sink, the fixtures, and half the chairs from the kitchen table, you're going to get to write a big check. And there are fraud penalties if you get too aggressive. So Don and I run the CPA practice, and we have a combined about, close to 65 years of experience in being CPAs. I run the practice. We run the practice under what we call the "we're all adults" rules, which means you're all adults. You guys know the difference between a business expense and a personal expense. If you don't know, pick up the phone and call us and ask. But unless you want to pay us thousands of dollars a month to review every one of your Costco bills and every one of your Home Depot bills and every one of your checks to Vons or Ralph's or wherever, if you call something a dental supply, we're going to put in dental supplies. If you call it an office expense, we're going to do that. There's a saying that Don and I use in the practice, which is pigs get fat and hogs get slaughtered. Don't be a pig. Don't get slaughtered. Okay. So let's go through some of the major expenses that you're going to have that you can write off. Don was mentioning automobile. So, everybody wants to write off 175% of their automobile. So we're going to recommend that you take a percentage of your automobile. Driving to and from work, and we got a slide coming up on this, I believe, it is not deductible generally. But if you drive to the lab, now, nobody's doing a whole lot of driving these days. That will hopefully change later this year. But, driving to CE, driving to the accountant, driving to the lab, driving to, whatever you're going to do for business, that is a major expense. The next, and I think we have a slide on this coming up. The next expense is equipment purchases. So folks, we're now at the beginning of a year. So you got the whole year to plan. So if you have a practice and you're thinking, you know what, I'm really liking the CEREC machine, okay? And the CEREC machine's $135,000 or, Plan Mecca, whatever you want to buy, right? You buy the machine and you make crowns. It's going to save you money. It's going to save you money on the actually going to a lab, okay? I mean, the lab techs use the CEREC machines. They use the same things that you do, except they're bigger, right? So for equipment purchases, we have this thing for federal purposes called bonus depreciation, which means that we can write off 100% of the cost of any equipment, leasehold, qualifying improvements, furniture, computers, okay? The one thing I will tell you, and this is as technical as we're going to get tonight, if you're going to buy a bunch of equipment at the end of the year and you go to the bank and you get a loan for $200,000, the question you have to ask your CPA, and you might want to write this down, is, do I have S corporation basis to take the deduction? If you don't ask that question and you plan on that deduction and you take a loan through your corporation, you're going to be disappointed. Just write that down. Do I have S corporation basis? That's all you need to know. So equipment purchases are a great way to get through all of this and to cut your taxes. Dollar for dollar deduction. Don, talk about putting the spouse and the kids on payroll.
Yeah, so a lot of times at the end of the year, one of those other discussions we'll look at when we're trying to figure out how much tax is there and what ways can we keep more dollars in the family, but also get a deduction. Well, with the itemized deduction and the standard deduction that we talked about earlier, the standard deduction is going to be applicable to any taxpayer, even children. So imagine you got a teenager, 14 years old in the family, and he may be working in the business. Maybe he needs to start working in the business. If he files a tax return, he gets to exclude around $12,000 of income. So if you're sitting there at the end of the year with your doc and you're talking about the numbers, well, you can pay that child $10,000, $10,500. We never want to push the limit, all the way up. It looks a little suspicious. But if you do that, you were probably going to give money to your child anyway, for a car payment, spending money, what have you. Maybe do something for an investment, but that came out of your pocket. Well, if you can now write that $10,000 off in the business, lower your tax bill, give it to the child and then them not pay any tax on it. Boom, win-win for everybody.
Okay. I want to touch on a little bit retirement plans. And again, we have 2 hours to cover a lot of information. We can certainly help you if you want to set up a retirement plan. We have 3 plans, baby bear, mama bear, papa bear. The baby bear plan for most of you that are going to start a retirement fund, if you're going to put away more than $6,500 in an IRA, is called a simple IRA. And the simple IRA allows you, similar to a 401k, to defer up to a maximum of $13,500 a year out of your salary, or if you're a proprietor, out of your proprietorship income. I'm going to guess that most of the folks on this call are not over the age of 50 because this is a new dentist webinar. But if you happen to be on this webinar and you're over 50, you get to do a catch-up contribution for an additional $3,000. I made the huge mistake one day when my wife turned 50. And I said, sweet, because she was on my payroll and the accounting. She did, marketing and all kinds of stuff for me. And I said, oh, sweetheart, guess what? You get to put an extra, in this case, it was $5,000 away. Why? Because you turned 50. Wrong thing to say to your spouse. Really bad. Don't do that. But for the simple IRA, you can put up to, and for you, and if you put your non-working spouse on the payroll, you can get up to about $35,000. The next choice you have is what's called a profit sharing plan. And most of you will set up a profit sharing plan with a safe harbor 401k. And that would allow you to put away up to $57,000 a year for yourself, including a 401k contribution, which would be about $20,000. And in addition to that, you can have your spouse on the payroll. You pay your spouse just enough to do a 401k. You can get to $75,000 to $90,000 very easily. And the amount that you have to put away for your employees is usually in a profit sharing plan, $5,000 to $15,000. So you're getting most of the money. The government's paying for probably 40% of it. And it's a really good deal. And that's what many of our doctors have. I mean, think about it, doctors. If you could put away $50,000, $60,000 a year starting when you're 30, 35 years old. I mean, just do simple math. $60,000 a year times 30 years from the time you're 30 or 60. If the money doesn't earn a dime, that's $1.8 million. If you start putting money away and you do that for 30 years, you'll have $4 or $5 million. You'll have plenty to retire on. Start early. If there's anything that I can do for you in this webinar, it's to really make a call to action for you guys to start saving money. For some of you, it may not be possible, but do it if you can. And then if you get to the point that you're 40, 45, 50 years old, and you're really doing well in your practice, we have this thing called a defined benefit plan, the Papa Bear plan. We have doctors putting $200,000, $300,000, $400,000 a year away. For most of you, that's probably not the case. So let's go to the next slide. Put your spouse on the payroll. Don, talk a little bit about that.
Yeah, so it goes back a little bit to the other comment, but what we always want to be careful of is just putting a spouse or a child onto payroll just because you can make it happen doesn't mean you don't have certain things that you're responsible to do. Like any employee in your practice, you should have a personnel file and have some duties and something that reflects that they actually are doing work. They very well could be doing work. Maybe it's the child was working during the summer doing some things. Maybe the spouse is your office administrator, but you don't want to just arbitrarily pay money without there being hopefully some evidence that anybody in the family is doing something, so that if you had to reflect and support exactly why you're paying out to the family, all this money, that they've got some duties.
Okay.
Yep.
And you can put 20,000 into their retirement plan, allows you to take them as a CE on CE trips soon, we hope. I know there are some CE providers. My dear friend, Deborah Engelhart Nash back in North Carolina, and her husband, Ross. I worked with Deborah back in the 80s. If you ever get a chance to hear Deborah lecture, she is one of the top consultants in the country. She is one of the funniest human beings I have ever met. And so if you get a chance, go to her and Ross's courses. They're starting some courses. There are other providers that are starting courses. As far as CE goes, I'll take a little side note here. The dentists that are the most successful in our CPA practice are the ones that spend a lot of money on CE. We have a doctor who, and I'm not shy, I know the main providers out there, John Coyce in Seattle, Frank Spear through the Scottsdale Center, Las Vegas Institute, Pankey is wonderful. I had a doctor who spent $80,000 in 1 year on John Coyce's courses. And on my podcast, if you ever want to listen, I interviewed Johnny Coyce, John's son. And the Coyce Center is unbelievable. I mean, so is the Scottsdale Center. They're all great places. And, you know, I said to him, I said, so why did you do this? And we're sitting in a Coco's, and this is a very quiet doctor. And he says, oh, Art, it's all about fit and function and what's best for the patient. I thought he was going to get up and start doing an Irish jig in the middle of the restaurant. It was unbelievable. Spend money, become a great clinical dentist. And doctors, maybe the best advice that we can give you tonight, we're not going to have a CDA South this year, but whenever you go to the next dental convention that you're allowed to go to, okay, and you get your CE, don't go to a course on occlusion. Don't go to a course on TMJ. Go to a course on how to communicate and talk to your patients. That will be the best course you ever go to. So we talked about putting the kids on the payroll. You know, if the kids get paid, they can get up to $12,550 without paying any income tax, federal income tax. And you might get a deduction as high as 37%. You got to set up the kid with a personnel file, pay him a fair wage. They can help stuffing envelopes. You can even, Don, we can even put them on as a marketing fee on the brochure. We've seen that done, right?
Yeah, websites and brochures and things of that nature. Yeah.
So putting your kids on the payroll is a great deal. You know, I have some clients that put their kids on the payroll and the kids never see the money. That's a conversation for the attorney, but that's, you know, you use it to help them fund college. You know, maybe it's a great learning thing. You say, all right, listen, son or daughter, I'm going to pay you, you know, $20 an hour and you're going to help me with this. And we're going to make a deal. Half the money you get to spend on whatever you want to spend on. The other half, we're going to put in a savings account for a car. Or if you want to take a graduation trip or something, it's a great way to teach your kids responsibility about money. Okay, let's go to the next slide. Automobile. So this is just a little more of a deep dive, Don, that we're talking about. Must use it for business purpose. To and from work doesn't count. Most of our doctors, Don, pick a percentage, right? Isn't that what they usually do?
Yeah, and as you're chatting, I'm just grabbing one of the questions in here. Just somebody was asking about the commuting part and being an independent contractor and just talking about what mileage is deductible. So if you just want to expand on that, I'm typing a couple other answers. So if you just want to talk about that.
Yeah, so theoretically, if you drive from your home to office A, and then you drive from office A to office B, that is deductible. Okay. Usually driving, Don, from the house to office A and to different offices, how do you usually treat that?
House to your initial place of work for the day is considered commuting. But yes, if you had multiple offices, or if you started, like Art said, going to the lab, going to the post office, going to the bank, then yeah, you start having quote unquote business mileage. If you drove to a CE course in Napa Valley, that would be considered business travel. So those would be mileage.
But if you have two offices that you work at, maybe one office is a mile away and the other is 30 miles away. Drive to the 1 mile away office first, check on things, check patients, then drive from that office to the 30-mile office. That's deductible driving. So, you know, and so that's how that works. You know, you probably shouldn't use 100%. The only time you use 100% is if you have a car, you park it at your office, it stays there, and you just drive it to the lab, to CE, to the accountant, to your other office, etc. Most people don't do that. Now, if you buy a car that's over 6,000 pounds, what's called GVWR, gross vehicle weight rating, you can take 100% bonus depreciation. That's going to be your Chevy Tahoe. That's going to be your Ford, I'm sorry, Chevy Suburban, the Tahoe, the big 6,000-7,000 pound cars. So if I buy a Chevy Suburban, which weighs 1 million pounds, right? And well, that's what it seems like. I've driven them. Cost 50,000, and me and his CPA firm, my CPA firm is called I'll Write Off Anything CPAs. We agreed that the business usage percentage is 80%. So I can take a deduction of $40,000. Next slide, Amanda, please. So if it's less than 6,000 pounds, with bonus depreciation the first year, you get 18,100, year 2, 16,001, year 3, 9,700, and year 4 and forward is $5,760. You take it times the business deduction. You need to keep a log. So in an IRS audit, what happens is they say, okay, show me your log. And then we all laugh about that because nobody keeps a log, right? So what they'll do is they'll say, okay, Dr. Watson, I'd like you to show me your calendar for the month of February and the month of October. And they're going to look at your calendar. And if you don't have a whole bunch of business appointments, they're going to disallow your card. Is that the end of the world? No, you have to write a check. But don't play pig, try and keep track of it. And if you don't use your car a lot, maybe you take the standard mileage rate. We can have that conversation. I want to get into some other things here. So let's go to the next slide. So equipment purchases, we have 100% bonus depreciation. You have to be placed in service by the end of the year. For California, you don't get the bonus. You get a maximum of $25,000 a year plus depreciation. If those of you, if you're building a new office or you're expanding an office, all I'm going to tell you, because this is another 2-hour conversation. In fact, on the podcast I told you about earlier, in the next month, we're going to have Mark Rogers from Eide Bailey, who heads up our cost segregation study group. If you build out a new office and you spend $500,000 on it, there's a way to avoid writing everything off over 39 years and writing it off a lot faster. It's called a cost segregation study. Don't have time to get into it tonight, but we'll talk about it if you want to give us a call if you're building out a new office. Let's go to the next slide. Okay, so now we're going to spend the rest of the time. We might go a little bit over, folks. Those of you need to jump off at 8 o'clock. We understand. I might go 5 or 10 minutes over. So I want to give you some ideas about metrics and KPIs in your practice for those of you who are buying a practice or those of you who are going into a new practice. So I'm going to hit you with a whole bunch of things here that I hope will be helpful to you. Number one is your fees. In a cash basis business, I got 2 ways to increase my profit: increase my revenues, decrease my overhead and my expenses. So are your fees in the 80th to 90th percentile? There is a group called the NDAS, and they do an annual fee schedule in a big city. They'll pick Atlanta, they'll pick New Orleans, they'll pick a city, they'll go and survey hundreds and hundreds, thousands of dentists, and then they will interpolate it. And they'll say, okay, the cost of living in Los Angeles is 1.05 times the cost of living in New Orleans. So LA's fees are going to be this, and they're pretty close. And they give you a fees in the 60th, 70th, 80th, and 90th percentile. We have the fees for every zip code in the United States. Take a look at your top 10 production codes. Your 1110, your Propy, 2750 is a porcelain crown, 4910 is non-surgical, is a perio recall. Look at your top 10 fees, see where you're at compared to the rest of the world. Okay. If you do 200 crowns a year, which is about 15, 16 a month, and you increase your fee by $75 per unit, that's $15,000 in your pocket. And there's no overhead cost with a fee increase. Now, those of you that are contracted with PPOs, and again, I don't mean to keep hawking my podcast, but I'm going to have Clint Johnson on from Profitable PPO in Arizona. We're recording, I think on Friday, and we're going to talk about, how do PPOs work? Who do you contract with? How do you get higher reimbursements? So we're going to talk about all of that. Let's go to the next slide, Amanda. So PPOs in your practice. One of the series that we're doing through these 6 dental societies is going to be in June. with a gentleman by the name of Gary Takis. Gary is a dear friend of mine. Gary has a podcast, two podcasts, one called The Thriving Dentist Show, and the other podcast is called The Less Insurance Dependency Show, which he does with Naren, who is his marketing director, has a marketing company. And Gary is going to talk about how to reduce dependency of PPOs in your practice. We all think that you have to take every single PPO or you're going to fail. The average discount on PPOs is 38% from UCR, okay? Do the math, folks. If your profit margin is 30 to 40%, you can't make a profit by taking PPOs with that level of discount. So, you know, there are lots of different groups of people that have, that are fee for service. You've got people over the age of 65 for the most part that don't have dental insurance. You've got the gig economy, the Uber drivers out there, and you've got the self-employed. Many of them don't have insurance. You have to make a decision as to what you're going to do. We're not going to get deep in the weeds here, but I'm just giving you some information. If you have a practice with a bunch of PPOs, you want to come up with a plan that's going to help you reduce your dependency. If you're getting 80% or more on procedures through a PPO plan, I can probably live with that. But if you're not, I mean, we had a doctor, Don, who 70% of their practice was Delta. We'll talk about Delta here in a second.
Right.
And she was getting an average of 30% UCR. And she says, Art, I'm putting thousands of dollars every month. What do? I said, you must go out of network. You don't have a choice or you will fail. You'll go out of business. It's like the restaurant right now. Not as of yesterday, they opened up restaurants in California for outside dining, but it's like the restaurant that couldn't do anything but outside dining. You have to do what you have to do. So if you are buying a practice that is a Delta Premier only provider, here is what you need to know. So these are for the doctors that are going to be buying practices. Delta Premier is a program that Delta Dental, which is the largest dental insurer in California and probably in the nation. Delta Dental of California, many dentists, we're probably down to probably 6,000 or 7,000 now. There was 8,800 about 5 years ago. They're part of the Premier only program. So they are getting 85 to 95% of UCR through Delta Dental's Premier only program. The problem Delta Dental has is that since 2008, I can probably count on one hand the number of Premier only contracts that Delta has sold to businesses and individuals. Nobody's paying for them anymore. So Delta Dental is getting the PPO rate from the insureds, but they're paying you the Premier rate. They don't like that. If they got rid of Premier, they would basically, everybody would go out of network because the Delta PPO fees are the lowest pretty much of all of the PPOs. When you buy a practice, Delta will require you, if you want to be in network with them, to also accept the PPOs, okay? That's what they're going to require. So it's going to probably, most practices have 20 to 40% of Delta patients in their practices, and you're going to experience a 20 to 40% drop from the Premier fees to the PPO fees, and you need to look at those. Good luck at getting them, but you need to look at them, okay? So most practices, when you buy a practice that is Delta Premier only, will lose an average of 7 to 10% of gross revenues out of the gate. How do you make that up? Maybe you do some extra procedures. Maybe you do some marketing. A lot of the older doctors out there don't do any marketing. Many of them don't even have a website. I even have some that don't even have a dental management program. It's amazing. So going out of network, listen to Gary's Reduced Dependency on Insurance podcast. Gary, there are some states in the country that you can go ahead and that you can actually buy a practice as a non-dentist. Gary is not a dentist. He has Life Smiles Dentistry. He tells this story on his podcast all the time. When he bought the practice, it had 33 PPO plans, was doing about 350,000 a year, and they were writing off 38%. Over a period of 3 years, they dropped the plans methodically with good verbal skills. They retained 84% of the patients, and now that practice is doing over $3 million. I'm not giving away any secrets or any breaking any HIPAA rules, because Gary tells this story in lectures on the podcast all the time. So that's PPOs. Let's go to the next slide. Some more metrics. Production in a general dental practice should be about 70 to 75% by the dentist and 25 to 30% by the hygiene department. Okay, if the hygiene percentage is too low, if you only have 10%, you're not having patients reappointed. You should be reappointing after every appointment 85 to 90% of your patients. We work with a couple of different metrics programs. One is called Dental Intel, the other is called Dentametrics. They will both tell you from your Dentrix or EagleSoft or Open Dental software, what is your reappointment percentage? Your front office will tell you it's 100%. I will tell you it's not. Okay. Probably the national average is 50 to 60% is reappointed. Every single patient that walks out of your office that doesn't have a new appointment is a lost patient. So we've got to be looking at that. If the hygiene percentage is too high, that dentist probably has issues with case presentation. I will tell you that I get every year at least 1 or 2 phone calls. So here's the phone call. Okay, you can see me answering the phone, right? All right. Hi, who's this? Oh, hi, Susie? Susie from Dr. Smith's office. Oh, how are you doing? And this is Susie talking. Art, he did it again. Did what? He let 6 crowns walk out of this office that my 2-year-old could have diagnosed and sold. What are we going to do? I said, I'm suddenly a partner in your practice, right? So if we see that the hygiene percentage is 40 or 50% of the total revenues, that means the doctor is not doing good diagnosis, not doing good treatment. Maybe we have a problem with the handoff. One of the most important things, young doctors, that you can do in your practice is to make sure that the doctor communicates, that you communicate your treatment philosophy to the team. So if you're looking at a tooth on your, on your Schick, on your Dexis, right? Or whatever you're using. And you look at that tooth and you say, that particular tooth, that is a crown, okay? And your team doesn't know what your philosophy is. When are you going to do an inlay? When are you going to do an onlay? How do you feel about this? If you don't communicate your philosophy, that patient, when you walk out of the room, is going to go to the hygienist and say, do I really need to do this? Or go to the assistant. And they're going to go, I don't know. Instead of what they should be saying, which is, we are all on the same page for the best possible treatment for you. And if Dr. Watson says that this needs a crown, boy, we have total faith in our doctor. That's what you need to do, okay? You need to schedule to a goal. When I was at Pride back in the 80s, we used to teach that 60 to 70% of all the production should be done in the morning when the dental team and the doctor are fresh. You need to be scheduling in blocks. This is what a consultant can do for you, okay? In the hygiene department, we want to look at what's being done, that 25 to 30% hygiene. And we want to see that 25 to 33% of production needs to be in the 4000 ADA codes. We call that non-surgical periodontal maintenance, quadrants of root planing. The national average is 9%. Don, we have a client. I sold him the practice, and then he became an accounting client. And the doctor's wife, remember, the doctor's wife was the hygienist.
Right.
Right? And that doctor's wife had absolutely no desire to do any kind of root planing. And it was just scraping teeth. And the seller says, what do I do? And say, well, we hopefully just have, we hopefully hope that the doctor's wife retires, the seller's wife retired, and she ultimately did. And we brought in a hygienist, and the hygiene production went through the roof.
Oh, yeah.
And yeah, and your hygienist has got to sell your dentistry for you. Okay, you've got 60 minutes in an appointment in many cases. It doesn't take 60 minutes to clean teeth. You need to be educating and talking about, is there pain? You've got to be probing. If you're not probing at least once a year, okay, we got to find periodontal disease. Big liability issue. the link between periodontal disease and heart disease and liver disease and my goldfish dying. And you know, you got to do this, folks. So if you're only at 25 to 33% of the production in your 4,000 codes needs to be, you know, needs to be in the 4,000 codes for hygiene. Okay. Not diagnosing perio disease is not only a health risk, but it's a legal liability issue. Talk to any litigator about it. Okay. Next slide. We're getting close here, folks. Your case acceptance should be 65 to 75%. Doctors, go listen to people who teach case presentation. One of my best friends in dentistry is a gentleman by the name of Dr. Paul Homoly, Homoly. And I don't mention these people to promote them so that they can make more money off of dentists who hear my webinars. I promote them because they're the best. Dr. Homoly does talks about how you talk to the patient about the right side. You have a right side of your practice, the left side of your practice. Dr. Homoly on his website has a little 18-minute a little video called The Phantom of the Operatory. You've heard of the Phantom of the Opera. He talks about the Phantom of the Operatory. And it talks about case presentation. Doctors, let me urge you, this horrible COVID-19 pandemic is a humongous excuse for you to get patients to understand that all disease, most disease starts in the mouth. And if we can convince that patient, okay, that we can get their mouths healthy, they're going to have a greater chance of fighting this virus. I mean, if we get herd immunity and we get 70, 80% of the people taking the vaccine, that's great. But this virus isn't just going to they're not going to like take a knee and call it a day. It's going to be here. So we have to be cognizant that we teach people this. If we teach people that if we do more comprehensive care today, same day dentistry, when you have a patient come into the operatory, okay, and you've got a picture of 3 teeth that look like they've just been through Dunkirk or a war zone, all right? And they're going to look at that, and you're scheduled to do the crown on number 13, and you have 14, 15 need a crown too, and the patient can say, well, what about that? A picture tells 1,000 words. It's about communication. It's about caring. It's about trust that you need to tell your patients that you are concerned about their total health. Okay, and you're not selling. There's nothing wrong with this. So if your case acceptance percentage is low, then something is not being done correctly. Okay, encourage the same day dentistry, the digital x-ray. These are all things that a really good dental consultant can help you with. Yes, they cost money. And yes, they're not cheap, but I will tell you, a dental coach who can help you with scheduling and recall, financial arrangements, and case presentation, they'll just watch you present a case. I mean, we do this, Don and I have done this over the years, is get somebody to watch us do what we do. You know, everybody needs a coach, right? So that's what you want to do. Collection should be 97 to 98% of your collectible production. If you're only collecting 85, 90%, what does that mean? That means the front office is not collecting at the time of appointment. 50% on the first appointment, 50% on placing and cementing the crown when you finish it up. Or the front office doesn't have time to follow up on insurance or accounts receivable. There are companies out there that do insurance billing for you. But if we have one person at the front desk who's an expert, who's a veteran, and we have 2 people that are rookies, you're going to have problems because it's not going to get done. So we want to be watching these metrics. And this is something that Don and I work with our clients on, if you want to talk about it. So next slide, please. So we want to talk about overhead percentages, and then we'll wrap this thing up. Your dental team salary should run 18 to 20% of your collectible production. So that means that if you have $1 million practice, your front and back office people, not including hygiene and not including your associates, going to run you about 18 to 20% of your total production, $180,000 to $200,000. If the percentage is too low, you could be short-staffed. Maybe that means you have a low collection percentage, which could mean you don't have sufficient time for financial arrangements. If you're building out a new office, make sure that you have a financial arrangement room that you can shut a door and one-on-one, the treatment coordinator can talk to the patient about the options and how much it costs and how we can make it affordable and all this kind of stuff. Explain the treatment plans. It could mean your practice is seeing larger cases and you have fewer patients. That's a lot of cases. We see that in the prosthodontic practices or the high-end general practices. If your salary percentage is too high, it could mean significant discounts on PPO plans, or you're overstaffed, or you have long-term employees who keep getting raises and don't do their job because they're set in their ways. Next slide, please. I'm going to go through these pretty quickly because we're at 8 o'clock and I want to finish up and be respectful of everybody's time. 1 to 2% of your gross revenue should go to employee fringe benefits, which is like health insurance. If you provide health insurance, I always recommend that you provide X amount per month, 100 to 200 a month for employees, because if you have someone who's 25 and their premium is 200 a month, but then you have someone who's 65 and their premium is 1,200 a month, that gets expensive and it's not really fair. Your rent should run about 5% of your office production. If you have a big office and the rent percentage is high because landlords are tough and they charge a lot of rent, think about renting your office to a new dentist who might be trying to build a practice and share space. Dental supplies are 5.5 to 6.5% of collectible production. If you are a general dentist who happens to choose to place implants, this could run to 10% because Mr. Noble Pharma, Mr. Noble Biocare, and Mr. Straumann get really expensive too. Lab should run 6 to 9% of your percentage of your office cost, unless your office production, unless you have a CAD/CAM. If your lab percentage is low and you don't have a CAD/CAM, it means that you're doing more fillings, not presenting comprehensive treatment, and not selling cases. These are the things that we need to be talking to you about to see what your numbers. It's not just send Don and I a P&L and we'll do a tax return. So next slide. We're getting real close here.
This is it.
This is it. Okay. I timed this pretty good. Marketing is 1 to 2% of your total office production. Folks, you need to have a website that is really user-friendly. You need to have a website that is accessible on your accessible on your handheld, just as well as it is on your laptop. A lot of dentists don't know how to ask patients for referrals. Okay, here's what you do. Mrs. Smith, how did it go today? And she tells you that it was wonderful. Well, you know what, Mrs. Smith, we're fortunate that we hear this a lot. And I will tell you that when we had our morning huddle, we were excited that you were coming in today. We really, really were happy to see you. And if you, I don't know if you know this, Mrs. Smith, but we're always accepting wonderful new patients like yourself. And if you have friends or family members that value dental care the way you do and the way we do, and we feel like we give the best care in the county, please send them to us. There are, here's some of our cards. 7 out of 10 of your patients have no idea that the life's blood of your practice is new patients. Social media marketing is where it is. So here's my question. What's the #1 search engine in the world? Google. What's the #2 search engine? Who cares? Google is all that matters. 5-star Google reviews. Is your website interactive? Do you have video testimonials? Is it iPhone friendly, like we talked about before? On February 10th, come to our webinar with Christy Bolt. She's going to talk to you about everything and anything, the 7 top things to do to market your practice. All right, it is 8:03. Miss Amanda, you have been wonderful. I am sorry we couldn't get me to control the screen, so I owe you. Let's go to the next slide. I think that is about it. Can you, Amanda, go back to our go back to the beginning and put up our phone numbers if anybody wants to get a hold of us. So, folks, this is we're a dental CPA firm. We would be happy to help you if you are buying a practice. We do accountants due diligence. Our other partner, who's my dear friend of over 33 years, Pam Chamberlain, is wonderful. She's done hundreds of these. Don runs our tax and accounting practice. I do some of the consulting and the lecturing. We wanted to all meet you tonight. We are here to help. If there's anything that we can do to help you, let us know. I will leave you with our 5-word phrase that we use on the podcast every week. Failure is not an option. We are rounding the corner. You have a great career ahead of all of you. We're very excited to have been able to present to you tonight. Thank you to all the dental societies for helping with all of this. We hope the information is helpful. Don, any final words before we let everybody go home?
No, echo the same thing. Just appreciate everybody taking a couple hours out of their evening and spending it with us. And again, hopefully it was informational and helpful. And look forward to meeting you guys in the future.
All right. And Amanda, thank you so much for your help tonight. You are golden and wonderful and
Appreciate
all those
it.
great things. So on behalf of Don Watson and myself, Art Wiederman from Eide Bailey, thank you for attending. And the next webinar is February 10th. And the next webinar in this series is on February the 23rd, which will be with Jennifer Cavalieri of Fortune Management and Anita York on labor laws. And again, thank you so much for the honor and privilege of your time. And go get them in the office tomorrow. Nice to see you all and have a wonderful evening. Good night, everyone.
Good night.